Good mid-morning, everyone. It's green across the screen as the Nasdaq just turned positive. It was the laggard today so far. Interestingly, the Dow Jones Industrial Average has led markets higher today from the opening bell, up over 200 points right now. S&P in hot pursuit, and the Nasdaq just turning positive for the first time today. Certainly going to try and play a little catch up. But the Dow's up 0.83%. The S&P up about just shy of a 0.5%, and the Nasdaq again just turning positive at 0.08% to the upside. So far so good. This is on the heels of a mixed day yesterday with the Dow getting a little bit hit. And a little bit of risk off feeling yesterday. Certainly, we talked about that. And the general consensus, it seems to be the news headlines and the discussions across panels, across analysts, across different spectrums in the investing community had a decidedly negative tint to them yesterday for the first time in a while. Maybe it's because the Dow was getting hit. Maybe it's because investors are getting a little bit tired of the markets making highs, or at least the Nasdaq composite, and the others moving up so quickly that they're thinking, oh yes, we've got coronavirus crisis again, lockdowns looming again, and the market wants to go higher. Maybe not so much now. Maybe it's time for a pause. That seemed to be the prevalent thinking yesterday because those were the headlines. More coronavirus crisis spikes and talk of, have we gone too far too fast? Well, in my opinion, no, we haven't gone too far too fast. We certainly have gone very far. It certainly has been very fast. Is it justified? We're going to talk a lot about that today in terms of the leadership, in terms of the tech darlings, the FANG stocks and Microsoft. I lump them together. I always hang tag the FANGs with Microsoft because it is one of my favorites. And it also really moves pretty much in lockstep with the FANGs, even though those sometimes have their difficulties against one another. As a group, they certainly have performed beautifully. Microsoft, every bit as much. So we're going to talk a little bit about what analysts are saying about the FANG stocks of Microsoft, what they're saying about the mega cap tech stocks. That is starting to filter through certain channels as adding that decidedly somewhat risk off tinge to what we've seen so far. Some specific issues which have been out there, we know about them. There's nothing new, except now it's getting more front page news. And whether or not that makes a difference, we will see. We'll talk about. I don't think it will. I think ultimately the bull case remains, and we'll look at some graphs to prove that I believe is evidence that the bull market is going to continue. So we're always subject to pullbacks. We're always subject to days when we're going to see a couple of percent drops. There's nothing unusual. There's welcome to the world. This is how markets trade these days. This is the nature of markets, certainly the nature of American markets, certainly the nature of markets in a manipulated environment where really we don't have free markets. We have central command markets led by the Federal Reserve. So that's going to change things. But it also underpins the bullish argument, and we'll talk a little bit about that too. So I'm going to see if there's any questions, and then we're going to take a look at the indices, and we're going to look at some of the factors impacting the big mega cap tech stocks. So I don't see any questions up yet. So I'm going to go to a quick discussion of what I'm seeing. And I'm going to pull for some notes that I have, and I have some copious notes because these are the kinds of things that I like to track. Why are we talking about the mega cap tech stocks today? Because they are the leadership group for sure. They've been the leadership group in terms of the market since 2009. That's not to say that financials didn't have a very strong part in the 2009 liftoff, which happened in late March. After the financial crisis, the banks and financial institutions were hit so hard, they became the absolute bargains in the marketplace. And they were the ones that actually brought us out in March, end of March, February, April, and continued to sort of pull the market higher. The mega cap, and they were still mega cap and pretty mega cap back then, but they were certainly big cap tech stocks did well for all the right reasons, for all the same reasons they're doing well today, because they are generating larger customer bases, because they're generating tons of revenue, profitability, and mountains of cash. So yes, they're all pretty much brands on their own, brand names. We Google things right now. I Apple this. I'll Apple my app on that, and we have some of these things just become let's Netflix it, and so these are part of the lexicon now of our era, and these companies have all gotten stronger. So they made sense back then. They make even more sense now, and the financials, which really led then, are the laggards today. All right. So one of the problems the market has is trying to figure out, should financials be right behind the mega cap tech companies, and should they be helping push the market higher? A lot of analysts say they don't matter anymore, because we're going to take a look this quarter coming up starting next week. And we're going to see how the banks are really faring, and how they project their future, the trend, if you will, in terms of loan losses, in terms of what they're looking at, et cetera, et cetera. But right now, the focus is, and everyone's happy to have the focus on the mega cap tech stocks. So what are the problems with them? The problems are that, well, and this is just general consensus discussion of a compilation of hits and knockdowns and pushdowns and pushback that analysts give for why the market is getting scary up here based on the big cap tech stocks. Number one, they're more than 26%, and I'm talking about the FANGs. I'm talking about the movers, the FANGs, and Microsoft. If we want to include some of the other big mega cap tech stocks, then the numbers are even more impressive, except they're better in terms of the base of this rally is broader than most people think. But just looking at the FANGs and Microsoft, they represent over 26% of the S&P. So if they're moving up, the S&P is moving up. It's all boats are rising with the tide, and they are the tide. So that's a problem for a lot of analysts, because that means that are we seeing a broad participation in the rally? And the answer to that is unequivocally no. We are seeing participation, but certainly not broad-based, and certainly not on an equal weight basis. If you look at the big tech stocks on an equal weight basis, they're not doing as well as we think relative to the rest of the market. They're doing better, of course, but the rest of the market is actually doing worse. So you take that analysis and you kind of juggle, well, which is more important? The fact is, what's more important is they are weighted as heavily as they are in the indices. You can't change that. And people follow the indices that are weighted, whether they're price weighted, but most of the ones that we watch and pay more attention to in terms of the tech stocks, the S&P, and of course the Nasdaq Composite, Nasdaq 100, they are capitalization weighted. So as the price of these stocks goes up, as the valuation of these companies go up, their impact on all of the indices that they're in rises. That worries a lot of analysts. Is it a problem? It's a problem if these stocks falter and we understand or believe that there's really not much below them. And if they falter, the other stocks that have been brought up simply because they're also in indices and they have to get bought up, they're in ETFs and they have to get bought up when investors buy those ETFs. Really, if there's nothing much there, if the big mega cap tech stocks falter, the rest of the market below it that has been brought up, elevated with the tide, well, there's really not much there and they'll collapse. So that could bring the entire market down. This is the theory. This is the thinking. So what's wrong? What could go wrong with the tech stocks? There's a bunch of things. I'm just going to kind of reel them off. This is the potential bear case for mega cap tech stocks. Right now, the technicals on the big cap, the mega caps is coming in. They're coming in at based on the Nasdaq 100, they are 19% above their 150-day moving average. So looking at the Nasdaq 100 as representative of the big cap, mega caps that we're talking about, it's 19% above its moving average. That's a point, that's an extreme level that generally leads to a correction. So we're there and we're moving beyond there. So a lot of analysts are starting to talk about that. Amazon and Google face serious regulatory scrutiny for possible anti-competitive business practices in the US. Amazon and Google face regulatory issues also in Europe. Netflix now must compete with hard charging mega rivals in streaming and video. At the same time, they're piling on more and more debt in order to make original content because some of their other content that they were paying for has been pulled from them by the likes of Disney, for example. So Netflix got some issues there. European competition officials recently announced investigations into both Apple's Apps Store and its payment platform, Apple Pay. It's also been rumored that the U.S. Department of Justice is looking into the same issues here in the U.S. Facebook and Google have seen sharp drops in advertising spending since the coronavirus pandemic happened. At the same time, broadcasters and other large advertisers are lowering their prices for ads because advertisers don't have the budgets that they had because of the virus. So they're not making the revenues. They've cut their ad budgets. So that's going to impact some of these companies for sure, especially Facebook and Google. According to the Wall Street Journal, U.S. advertising spending is expected to fall by 13% in 2020. In December, it was expected to rise between 4 and 5%. So that's a quick reversal and unlikely to change trends. So we're seeing an overall deceleration in ad spending and, in fact, a negative turn in the spending. Social media companies, most glaringly, of course, Facebook, pretty much outraged the president and caused him to sign executive order rolling back some of the protections that the social media companies have. That's going to impact them. It's also going to impact some of the other tech companies also. You also have France is now looking at a digital tax. They've been talking about this for some time. I believe the US and France are actually having a call today to discuss digital tax, which France says it's not backing down from. So we've got more. There's more pushback on these big tech companies from Europe than there is internally from the United States. But there's enough here also politically. There's certainly more probably to come as we move into the election cycle. Things start heating up there. I think we're going to start to see politicians start to take shots at these companies. We've heard Joe Biden yesterday talk about Amazon. Its days of its low taxes are over if he's in charge. So the tech companies are facing a slew of hurdles domestically as well as internationally. So they all face, especially Facebook and Google, intense scrutiny over their data, privacy issues, and security issues. So most of these issues are not new. We've been talking about them all the time, and these companies' stocks have continued to rise in the face of everything we know is out there that may be a hurdle to them in the future, a hurdle to their business models even, but hasn't stopped them from moving higher, hasn't stopped investors from crowding into that. That's another problem that investors have, that analysts have, I should say, is that investors are crowding, have been crowding, and continue to crowd into these names. And the reason they're going up is because of this concentration, this crowding. And that's recently, since the pandemic, that's been emphasized by retail's advance into these companies, which helped boost them further. And you have the problem of managers, portfolio managers, mutual fund managers, and others who lag behind their benchmarks, which are really propelled, we know, by these stocks. They have to then pull sideline money and or sell other issues and buy into these to chase those stocks higher. Why? Because they have to have them in their portfolio come quarter end, because they look stupid if they don't, because that's where the performance has been. So you get another level of buying and you have more concentrations. This is a problem for a lot of folks. It's only a problem, in my opinion, if these stocks start to falter. So I don't see them faltering. So there's plenty of reasons that these stocks have been the leadership group. There's plenty of reasons that they'll continue. They were the leadership group for the market long before the pandemic started, for all the right reasons. They are the biggest companies in their field. They are the most profitable by far. They're the most profitable companies, some of the most profitable companies in the world. So They have ecosystems, they have the products, they have the services, they have the apps, they have the cloud features, they have online sales, they have everything that's necessary, everything that the world has moved towards and now is moving towards at a faster pace since the pandemic. So all of the things that they do, all of them are more desirable now, whether it's a product or a service, because of the coronavirus, because of what we've experienced since the pandemic has befallen us, makes them worth more. So justifiably so, investors recognize this, have been bidding up those stocks day after day, pretty much. So I don't think there's a problem. I think the leadership can continue as long as we don't get overwhelming regulatory pushback on these companies, overwhelming political pushback that's not rhetorical, that becomes matter of fact, and we start to see investigations and we start to see settlements necessary in order to move forward. Then we're going to have an impact on these stocks. And if that starts to happen, investors will recognize that perhaps the bloom is off the rose for a little while, pending what outcomes there might be. So until that happens, and again, these things are issues that have been on the table. Until that happens, I don't think we have anything to worry about. The market is absolutely sturdy as long as these companies are in tip-top shape, and they are. They are generating tremendous revenue, profitability. Profits are, by the way, they're great. But all the profits for all the tech companies, except I think Microsoft, are actually down in the first and second quarter because of the crisis, the pandemic. Are they good? Yes, they're absolutely solid, but they're down. Okay, doesn't mean that they are losing money. It just means they're not as profitable as they were the previous quarter to 2019 for Q1 or Q2, especially in Q2. But they're still profitable, they're still generating cash, and they're still on the right side of the equation in every respect. So we're going to have obviously a closer look and hopefully an internal look into their metrics come earnings season. And that's right upon us now. So we're going to get a clear picture. But the market is digesting all that and says, whatever it's going to be, even if it's bad, it's over. It's only going to get better. So again, for these stocks, are they recession proof? Yes. Are they entirely recession proof? No, not for in terms of ad spending, for example. They're not, but they're certainly going to hold up better than any other companies. And they have become, and this perhaps is the most important point. This is a point that eludes a lot of analysts who are negative on the big caps because they think they have gone too far too fast. They have all become defensive plays. Okay. When there are problems, we see people rushing into them as a defensive maneuver. So that's not going to change all of a sudden. Why are they defensive plays now? Because they have the fortress balance sheets, if you will. Netflix perhaps being an exception to that fortress balance sheet moniker. Nonetheless, these are defensive stocks. What does that mean? It really means if they come down, they are going to be all of the primary candidates for the buy the dip crowd. And the buy the dip crowd has been right. It's been right since March of 2009. It's been so right that if you haven't bought the dips, you haven't done nearly as well. If you bought the dips, you have made so much money since 2009, you probably can't even count it. That's what buy the dip has done. It's also been ingrained in everyone now. And the latest, greatest iteration of buy the dip was the March dip. Anybody who bought that dip, everybody who bought that dip is raving about how much money they've made. So there you go. How far are we going to go down if we get some kind of hits based on existential something, based on political something, based on technicals? Who knows what it could be that could trigger a sell down? Yes, it's entirely possible. How far will the market go down? Not far enough for us to get in at levels that we saw perhaps in March. Why? Because if these stocks come down, they are going to get bid up because the buy the crowd will jump into it. So there we go. That's my basis for my bullishness, and I think it's going to continue because I don't see it any other way. Here we are again, Friday, on the heels of a bit of a sell down yesterday. We still have a very positive week, and it looks like we're doing very well right now. Dow is again holding up to double-digit gains, up 222, and S&P up point, I'll call it 0.5%. Nasdaq is right on the borderline of being positive, so it's just pretty much on the flat line right there. So, but it's Friday. Unless we see some heavy selling into the close today, which always is possible, unlikely given the actions so far today, given the fact that Europe ended on pretty much the highs of the day for most of the European bourses. It's unlikely that we're going to see a reversal of fortune for the Dow and the S&P today. And speaking of the S&P has experienced a golden cross, and we're going to take a look at that. And that's really bullish. I know a lot of you know what that is. Some of you don't. We'll talk about it. But the bottom line is, when it comes to golden crosses, they have been historically bullish signals. And we're going to take a look at a couple of those. So I'm going to just have a quick gander at some questions if you guys have any. And I don't see any, either that or they're not coming up. No questions yet. So I'm going to go we're going to go take a look at some charts. And if you have any questions, pop them up. And let's go take a look, see what we can see on some of the charts. We're going to look at the FANGs and Microsoft. We're going to take a look at the banks, the laggards, and we're going to take a look also at the major benchmarks. We're going to take a look at a couple of golden crosses, see where we are there. So let's go take a look. I catch you there, Guy. We'll take a look at Bank of America. We're going to look at all the banks, but I see you're asking about Bank of America, and we're going to take a look. Okay, first up, Dow Jones Industrial Average. We're going to look at this on a regular basis. Why? Because a lot of folks follow the markets, follow it vis-a-vis the Dow. Most of your mainstream news outlets, I'm talking about the benchmark news media companies, ABC, NBC, CBS, they all quote the Dow. So it's the financial news programs that gear towards quoting the S&P and the Nasdaq composite, though the others are doing that now. But most of them, for most folks, it's still the Dow. So let's take a look at the Dow. Same old story we got here, folks, right? We're in this little bit sideways channel, which we spoke about yesterday. We've been speaking about, and here we are. It's not bad. It doesn't mean anything. We're going to end up probably hopefully near the highs of the day today, which is a positive. But we're going to get above here. We get above the 200-day, which is about 26,281. That's the 200-day moving average. That bodes well for the market. What's also happening is we're seeing the 50-day rise, and that's going to start to accelerate. And if 50-day crosses above the 200-day, we get what's called the golden cross. Right? There's lots of different ways to look at a golden cross, meaning there are different moving averages that folks look at for what is their golden cross. For the most part, generally speaking, the golden cross that most people talk about and that analysts talk about, and you'll hear in the media, the financial media, and occasionally in mainstream media, is the 50-day and 200-day moving averages. And the 50-day crossing above the 200-day after it's been below it is a bullish signal. The S&P, let's take a look at the S&P now. And this is what everybody is talking about who is interested in looking and following what might be a golden cross. And there it is. So why do I bring it up today? Because it just happened. We have the 50-day has just recently crossed above the 200-day. Doesn't matter how much, it happened. So we're looking here at the 50-day, very steep rise, and crossing above the red line, which is the 200-day moving average. Now we're above it. Hence your golden cross, a very bullish signal. Meantime, we see the S&P outside this uptrending channel marker and looking like it's going to try and work its way back above this short-term resistance here, above that, and get back into the channel. It's not going to take a lot for that to happen. And if the S&P 500 gets above 3,235 thereabouts, it's going to be an extremely bullish signal and a strong likelihood that it'll be just a matter of weeks, barring something outside the markets pushing them down. If we have a clear runway and we get the S&P back in that uptrending channel, having experienced the golden cross and breaking above its resistance at 3,235, 37 thereabouts, I'm calling it 235, we're going to see a lot of sideline money come in and chase the market higher. And we're probably going to get another leg, very possibly to new all-time highs for the S&P. Nasdaq Composite, well, we can say what we will about the Nasdaq Composite. There's not much more to say other than stellar, amazing, just parabolic. And there you have it. So clean and green all the way, nothing impinging on this one. And if you look at the golden cross here, where the 50 came up here above that, and you thought, okay, where's the market? When that happened, the market was already way up here, right? I was already really very close to its all-time highs and just powered higher. So the golden cross, whether you believe in it or not, does influence traders and investors. And it certainly, more often than not, will bring money onto the table as opposed to keeping it sidelined. So those are your benchmarks. As far as, we'll have a quick look at the Russell in terms of the ETF that we talk about that tracks the Russell 2000. Similarly to the Dow, it's a ways away from seeing a golden cross, but it's trying to make its way back up into its upward trending channel. The bottom of the support line here for this uptrending channel marker, and so far so good. Up a very healthy 1.53% today, which is a good bit higher, triple what the S&P is in terms of percentage gains today. So that's a positive. If we see all the indices moving higher, that's, needless to say, a positive. And it's pretty much, they've been in that mode moving higher. So let's have a quick rundown of the FANGs. Let's start off with Facebook. We're going to take a look and see how they're doing. So they're getting some pushback again for the reasons that I laid out, which again, there is no new news there. It's old news. This stuff has been out there in terms of regulatory pushback, in terms of presidential pushback, in terms of political pushback and taxing, and on and on and on. It's been there. Security issues, privacy issues, on and on and on. In terms of Facebook, which has been taken to task for hate speech and communication on this platform. So nothing new. You see these kind of little blips here. Yes, that's news. That this and that might happen, and boycotts and this and that. And then what happens? Investors just decide that's a good opportunity to get back in or add. That's an opportunity, if you've missed it, to jump in. That's certainly an opportunity to add if you know this Facebook story. And in spite of the fact that ad spending is coming down, Facebook stock is representing that will eventually change, even if it's not this year. It's going to change, and Facebook's going to continue to make money. In the interim, it's still going to make money. Okay, there's plenty of other things that Facebook will do to make money. And ad spending is so huge on Facebook, it's going to continue to power it by itself. So the stock looks absolutely brilliant. There's no real reason to fade this stock, meaning bet against it. I just don't see it. You just look at that performance It's great. Does it look lofty? Does it look overvalued? Yeah, it looks scary, but scary means nothing. That's a psychological answer address to what you don't understand. If you understand why and how the stock has been powered higher, then you know it's justified. So pretty easy. Apple. Let's take a look at Apple. And what is Apple doing? Going to the moon. Okay. You just can't beat that. You can't beat that stock. This is just beyond words how compelling Apple is, has been, and will continue to be. As long as Apple is generating the cash that it does, as long as it refreshes its products during the cycle upgrades that they expect, as long as it's continuing to expand its ecosystem, and it's doing all of that and more, and Apple has yet to really break into healthcare in a way that everyone expects it to do. And it's working on that, and it's showing signs of making some progress. It's got a long way to go, but Apple has never been a leader. It gets knocked for being a follower. It doesn't matter. Apple is not about leadership. It's about being the best, not the first. And so no reason for Apple, given its profitability, given the cycles for its products, given its ecosystem, and given where it can go, nothing wrong with owning this, even adding to the position. Amazon's getting probably more flack than any of these, and that's political flack. Nothing new there. I have said that if any of the companies is to get broken up, eventually it would be Amazon, and perhaps others might be subject to that kind of discussion, but certainly makes sense from a political point of view. If you want to put pressure on a company to represent that you're about egalitarian opportunity in the economy, and that Amazon has been crushing everything from retail to mom and pop shops, then and grocery, you name it, Amazon is crushing it. Then you can make a case that Amazon should be broken up. That case has been out there. It's been out there for some time. And look at the stock. Doesn't matter. Absolutely doesn't matter. So this is, again, these are healthy reasons, because Amazon obviously continuing to do well, even better during the pandemic. So I don't see, looking at these charts, I don't see any reason for these stocks to turn tail. Here's Netflix. Are you kidding me? Up 5.5% today. Okay, just making higher highs. And, why would people all of a sudden bet against Netflix? Why would they? They might take profits on any given day. We can see investors take profits, and they're not wrong to take profits. You're never wrong taking profits. But a lot of those investors who do take profits, if the stock ends up falling after they've taken profits, they're going to look for places to get back in. They'll buy the dip crowd. The profit takers are going to get back into the stocks they've had tremendous runs with, because they know that everyone else is going to pile in. So how low can these stocks go? I don't think that low. We're so far past the March lows. Is it possible that we could retrace and go back down and test the March lows? While anything is possible, it's looking less likely as these stocks continue to power higher. Again, because if they start to come down, as defensive in nature as they are, they'll get bought up. And that will put an end to any hard selling for a while. Barring something left field, like the pandemic, like another pandemic, like something out of space coming down. Other than something like that, an existential threat, all the other threats are known. Okay, so it just doesn't look just terrific stuff. You can't fault. And looking at Google, Alphabet as it's called now, I still refer to it as Google. Same story. Okay, issues, climb the wall of worry, gotten back up, and going to make new highs, higher highs. And there's nothing else you can say about that other than you got to be in it to win it. So Alphabet, no matter what issues it faces, keeps going higher. I mean, it's so dominant in its field. You can argue that it's too dominant and it needs to be broken up or needs to be regulated differently. You can make those arguments. People have made those arguments for more than a decade. And what has the stock done? You can see what the stock has done. Okay, it's continued to do that and will continue to do that. Okay, all right. So we went back. Let me just go back here and check on any questions before I go back to. Let's see if you guys have any questions before we go back to the charts. I want to maybe have a quick look at the banks. Okay, Guy, you asked about Bank of America. We'll take a look at that. And I'm going to work from the bottom up. What about BRK.B? Well, we'll take a look at that. And I've got a little interesting tidbit on that one for you too. You might like that, Jersey. So we'll take a look at that. Ken's asking about BX and RTX. Take a look at those. And Sergio, afternoon to you, sir. How do you think the market closes into the weekend? Looking at it right now, the Nasdaq is just a shade underwater by about 0.06%. Dow holding on to double-digit gains, up just shy of 200 points. Now it's been trading above 200 plus points for the better part of a couple of hours now, and well, maybe an hour and a half or so. But certainly had a pretty nice, move up in the morning and continued to be strong. S&P has continued to hold its head up very nicely, and I just don't see any narrative out there pounding stocks into the close today. So my guess would be they'll do a little bit of something one way or the other from here, maybe up a little bit more, maybe down a little more, but probably not much more than where they are. Probably kind of stay around where they are, which means we end up the week on a positive note, means we end the week higher yet again on another positive week. So that bodes well. Again, the trend is your friend. Pretty much that's how I see it. Walter, JPM is going up today. So we'll take a look at JPM real quick. And I got a buzz shortly after these quick looks. John liked your recommendation on Vert. Oh, good. Thank you. Even though a financial dividend is nice too. Dividend is super. Yeah, everybody. John's pointing out to in the Money Map report, I recommended Virtu Financial and also Twitter. And for good reasons, but in the case of Virtu Financial, got a really great yield, and it's just in a solid place business-wise, considering what it does. Let's see. Louis is asking about Macy's and GE. And last but not least, I'm going to take we got BAC from Guy. So let's have a quick look at these guys, and then I apologize, I have to run. So let's go take a quick gander at these, and let's see what we can see. All right, we got to get rid of this. And let's have a quick look down so looking at Bank of America. Again, part of this is the bounce off of the hit that financials have taken. We're coming into earnings. The narrative remains, we know the numbers are going to be bad, but if they beat estimates, if they guide positively, if they say the worst looks like it's over, or they can see a turn, perhaps even at the end of the third quarter, given the level of some of these stocks and the financials, they're probably going to get a run. So again, this is what we're seeing today. We're seeing a little bit of reflection of the sell down yesterday and a bounce on that today. So Bank of America looking good. Still within that channel. JP, same thing. Seeing a nice bounce today. Again, just a reaction to yesterday, looking for a stopping point, looking for a resting point, looking for a reason to get back in as folks look at these stocks. And I'm also talking about the Robinhood crowd too, the retail traders looking for opportunities in these beaten down companies. They are leaning more and more, and they're going into earnings season. They're going to be leaning more into companies like the financials. Why? Because they're going to be perceived as having the greatest opportunity to move the most because they've been sold down and stayed down. So we'll take a look at Berkshire Hathaway. I think Jersey was asking about Berkshire. I don't follow Berkshire Hathaway. I like Warren Buffett. I don't love Warren Buffett. I think there's a lot of things that he doesn't say that he does that he wants to not be known for, but he does trade and he does lose money and he does this and he does that. 46% of the value of Berkshire Hathaway stock portfolio resides in one position: Apple. You get that? 46% of the value of Berkshire's equity portfolio resides in Apple. So what I get from that, what you should get from that is, as Buffett was late to the game, you can be late to the game and still hit it out of the park. Buffett way late to the game with Apple, and now almost 50% of the value of the portfolio because of what it's done. Staggering. So do I like Berkshire Hathaway? I think it's overpriced. I don't know about the portfolio companies. We know about Apple. We just talked about Apple, but some of the other portfolio companies in Berkshire, I'm not so sure about. That's why the stock is reflecting some malaise. That's because of the internals of some of the portfolio companies. They've got some old line companies there that are not going to perform as well, and he's stuck with them. He can obviously exit them like he exited the airlines. Buffett is known to maybe make those kind of moves, but at this point, not doing so well. So I don't love it. Would I buy it? No, still too rich for me. Again, I look at it this way. Why would you put your capital into something that isn't moving? There's other stuff that's moving. I'd rather put my money into Apple making new highs than I would into Berkshire Hathaway. That's just me. That's why I like to allocate my capital to stuff that's moving, not stuff that's not. BX is up next. And I like Blackstone Group. Blackstone just made a tremendous real estate deal recently, acquiring I think about a $64 billion portfolio, add to its already $145 billion real estate portfolio. Tremendous gravity. This company has tremendous gravity. Again, we got this little golden cross here. We had it down. It got negative here. We knew that was going to happen because we knew all about this. And then we've got this uptrend here. We stay above the 200-day. I don't care if we're below the 50-day. We have breached the 200-day. I like Blackstone longer term. Blackstone is a company that is going to have issues going forward. If you want to take a break and take some profits, if you have them, if you're thinking about getting Blackstone, you might want to think about holding off because the earnings coming out are going to be reflection of, generally speaking, what's going on for companies. And that speaks to the portfolio companies that Blackstone controls. All right, some of the portfolio companies they control are going to have the same issues we're going to see in public companies coming through the earnings coming up next week. So I'm not inclined to buy it right now if I don't own it. I'd look to buy a little lower, especially if it's just trading below its 200 and earnings come out, and it could take a little bit further hit. Do I want to own Blackstone at some point? Absolutely, I want to own Blackstone. Next up, we got, I think, taking a look at defense, the Raytheon Technologies Corp. And again, problematic to me in terms of that chart. It just looks tired, and we don't know what's going to happen with the election. We don't know what's going to happen with spending. We know the budget's blown up, and we know that defense may take a hit. We don't know, and it could take a bigger hit depending on who's going to win the presidency and what kind of administration we see, as well as who's going to control the House and Senate. So I'm not so sure that I'd be looking to buy Raytheon on the dips right now. That's my opinion on Raytheon. And we got a couple more we're going to bang out, and then I got to rock and roll, ladies and gentlemen. General Electric. Here's my story on General Electric. In a word, why? Why would you own this company? Look what it does. It's a day trading stock to me. Plus, look what it does. We're talking about aviation, jet engines. We're talking about other gigantic products that are expensive, where budgets are being busted all around the world. Do I want to own GE? Absolutely not. To me, it's just a dinosaur. If you want to own it, good luck. It's just me. I'd rather put my money somewhere else, plain and simple. And last but not least, I think you were asking about Macy's. And okay, another dead horse running, okay, backwards. What's the point? Again, you want to make a speculative play on Macy's? I say good luck with that. Is Macy's going to rise out of the ashes? Not in my opinion. Is Macy's a speculative play? It's worse than speculative. It's just downright, blind. I wouldn't put my money into it. If you want to play speculative stocks, there's plenty of other stocks I would like to play speculatively. In other words, taking the big risks for potentially big gains. You can take a big risk in Macy's and not be looking at really big gains, folks. I don't see this stock really doing a whole much. Can it survive? The company survive? Yes, it can. Will it? That's another question. So I think that wraps it up. And I'm going to wish you all a wonderful, safe weekend. We've got a storm heading up this way. I'm going to impact New York. Hopefully it's not going to be too bad. And with that, I'm going to bid you all a fond farewell, a lovely weekend. Be healthy and happy and safe. Cheers, everybody.